So I don't know if y'all can read that from back there. You have to get on Zoom, Maybe I'll read it. I'll read it out loud and we'll just talk through it. Yeah, it's recording. Yeah. All right. So somewhat negative view of the market. They got it pretty wrong on China. Everybody's talking about China. Y'all probably forgot about Silicon Valley by now. That's kind of been just old news. So not a great forecast, but you gotta put something down. So long-term treasuries, so they've got two bullets there. That looks good. Overweight due to falling, because of the economy. High quality due to the weak economy. Falling, I can't read that. Falling what? Expected falling. I think you meant falling rates. So, all right. I probably, if I could figure out what that word is, I would probably give you 2 points. Or there's two. What did they say about inflation? It's going to come down below the expectation, which means tips would be pricing higher inflation, so that'd be bad for tips. Or underweight due to lower inflation. So that's 3 out of 3. Underweight, we want to buy convexity. We prefer long-term treasuries. So what did I forget to put here?
The higher rates, right?
Not the higher rates, but volatility. Right? They said they expect stock markets and interest rates to be volatile. If all they said they expect stock market to be volatile, that doesn't tell you anything about interest rates. But they said volatile, so we're 3 out of 4, so that's good. Even though they said underweight and want to buy convexity, I might give them like, well, I don't know. They probably not much there. All right. And then on bonds, the 528 for preferred corporates. So there's a point. That's right. Corporates were 5.5. Munis were 370 divided by 0.7. So 528. So there's a place I would probably say within my bonds, within my corporates and muni bonds, I prefer corporates. High quality preferred, but medium is okay. They forgot to say why. All right. So that's the big thing that kills people because they're thinking it. Weak economy, so, but they didn't say that. All right. So it's actually good. They intentionally missed some things so I could show y'all what you need to do. All right. So you got to say why. If you don't say why, you don't get any points, even if it's correct. All right. No, you have to say why. So high quality preferred, why? High quality means we prefer long term, but intermediate term, okay, but why? Interest rates. So we've got 1, 2, 3, 4 out of 7 so far. Okay. This is not unusual though for the practice. All right. Junk bond underweight due to the soft landing. I'll take that one. So that's 5 out of 8. Large cap within stocks, overweight large cap. We got 1 out of 2. Why did I not get a point here?
You
didn't put why. All right. So you have to be repetitive there. Within stocks, I like the within stocks. That's good. So I don't know where we are now. 6 out of 9. So that one's right. Low beta due to expected soft landing. Small cap within stocks underweight due to more risk. That one, that's ambiguous. More risk of what? The economy or small cap? So I don't know what you mean. All right. So I might give them saying a half there because I don't know what they mean. We don't like high beta and we want to avoid more risk. So, I might give them 1 for the 2. So I don't know why we're up there. I can't keep track anymore. All right. Developed market underweight to expected weak economic growth. Be a little more explicit. Economic growth of Europe versus US. All right. Be real explicit there. US dollar is strong, so prefer to invest in US. So I'll give them 1 point there, maybe half a point there. Overweight to expected large growth in economy. I'll give you, since you're obviously talking about emerging, I would give you there. Here I might give them full credit because it's, expected weak economic growth. You probably mean of developed markets, but still be more clear. You never know what kind of mood I'm in at that point in time. All right. So out of 16, I think they've got maybe 10 or 11 out of 16, somewhere in that area. So, but they now see that, so it's going to help them. So be more explicit. Say why underweight and say why. Be real clear on why and avoid terms like avoid, try to use exactly what they said. I'm expecting a soft landing. I'm expecting a hard landing, whatever. Say those words clearly. Or you can just say do the weak economy or strong economy, put something like that in there. Underweight gold in real estate, do the strong dollar. And let's see, underweight gold. Yeah, I'm not real sure. The high dollar value, I think you mean the high appreciation of real estate. So I'm not sure on the gold. I've given you the overweight oil. Yeah, I don't know if I give you. She didn't really, or he didn't. Whoever wrote this didn't really give you much say on that. Yeah. Oil is a little tricky because inflation is not going to be very strong. That probably means oil prices are coming down. So on that one, I might give him 1 point for the real estate. On the gold, why would you avoid gold? Weak dollar, not much inflation. So on gold, that's there. So they probably get 1 out of 2 there. I was looking for 2 there, gold and real estate. So they're probably like 12 out of 18. So that's 60-70%. Now, can they do better when they do the exam? Yeah. So you can see how explicit you got to be. It's a little tougher in a team case because you're writing fast. But questions on that? You see how it works. They did a good job of arranging it, right? They got all the bullets, all the dots. They did leave out one really important thing. So you see what's the thing? What's the one asset class I don't give you? Stocks versus bonds. So what should they probably have said there? Overweight high quality bonds, avoid stocks. So there's one more there. All right, but practice it. I don't normally, like, if there's 18 things, if you get 9 out of 18, that doesn't necessarily mean 50%, because I might say, well, 16 is 100%. So if you get, 9 out of 18, it'd be 9 out of 16 for the grade. But you can lose a lot of points, especially on the, you can see they lost quite a few points just by not being more explicit on the corporates versus the municipals. Now, they said corporate spreads are going to widen. When you say corporate spreads are going to widen, that usually means munis as well. When people say corporates, they just mean spread bonds. Medium quality, if spreads are going to widen, I probably don't want those. It kind of depends. Treasuries are going to long treasuries are going to outperform medium, intermediate term corporates if you expect spreads to widen. Because they're both going to benefit from rates falling, but treasuries can get the long term plus the fact that there's no spread compression, no spread widening. So, all right. Any questions on that, JC? Yeah, because it's real. When they say high dollar value, that to me, I think they mean that she was saying real estate prices look stretched. So if you were to yeah, don't combine bullets for sure. Yeah, well, 2 things. Dollars rising, not much inflation, but the dollar rising especially because that's what's really been driving gold the last few years. Avoid or underweight. You're not going to avoid large cap. No one's going to go. This industry won't go to zero. They're more worried about career risks than they are about their client. If you go to zero and you're wrong, you get crushed. So the key with investing is it's not to make money. The key with investing is don't lose more than everybody else and make at least as much. The key is be with the herd. Because you lose clients when the market's up 5 and you're down 2. So that's your key. It's great to be a 5 and the market's down 2, but you get so crushed with so everybody's herd's really close. So you don't usually avoid, unless it's like you normally have 5% in gold and you're going to go to 0. That may be, even there, most people won't go to 0. They might go to 3. We're real timid because we're really much more worried about career risk. We just don't want our customers to fire us. I mean, have I told you the story? I said it with my risk management class. Whenever our hedge funds came in and they go, wow, we got such great news. We love meetings like this. They go, oh, wow, that's wow, because I thought it was a really terrible year. This was 2007. This was a horrible year for hedge funds. I said, no, this is great. We always love meetings like this. And go, well, how did you do? I said, we lost 20%. Oh, wow, that sounds really good news. Why were they so excited about losing 20%? Yeah, their competitors lost 25. And I go, well, you lost a fifth of the money. And he goes, I can see here. He goes, oh, yeah, that. Well, yeah, that's what the industry thinks. We lost a fifth of your money. We're so excited. It's like, oh man, I'm glad I hired you. All right. Any other questions on that? We'll see how this class does. If it does better than previous classes, I hope so. We'll see. All right, so we're talking about return, and we've got this holding period return, ending value minus beginning value plus income divided by beginning value. So let's practice this a little bit. Ah. So let's try Walmart. And for Walmart, let's try September, August, and July. We really can't do October yet. All right, so we have a beginning value, an ending value, income, and holding period return. So what price do we want for the beginning market value for July? What? Well, what price are we looking for here? What's the beginning market price for July? Is it July 1st or July 3rd? It's going to be what? June 30th, right? It's got to be the last day of the previous month. Okay. So June 30th, the price was 157.18. What's going to be the ending price for July? Well, that's pretty obvious. That's going to be July 31st. Ending price 159.86. And income. You see any dividends in there? I don't see any dividends. You see a dividend in August. Now, which dividend is this? What do you think Yahoo Finance does? Declaration, X day, or payday? You would think payday, but that wouldn't be the right one. So what do you think they do? Which number did we say is the most important? Not declaration. Okay, so X day. X day. All right, so you had three choices. X day. Why is X date so important? Because that's the date. If you own the stock on X date, you will get the dividend. So if you sell the stock tomorrow, it may not pay you until a month from now. But if you own the stock on X date, you will get the dividend. All right. So payment date doesn't matter. If you own it on payment date, it doesn't matter. It matters on what. So you can have it on X date, sell it the next day. You're still going to get a check for that dividend. All right. Declaration date doesn't matter. If you own it on declaration date, you have to have it on X date. X date was when the market adjusts for that stock for that dividend. Because if they pay 57 cents in dividends, that's 57 cents they've taken out of the corporation and given away. So the value of the corporation has to come down. So generally, when a stock pays a dividend, the stock price will come down by the dividend, but on X date, not on payment date. Because on X date, it becomes a liability. On X date, they're committed to paying this. So they actually set up a dividends payable liability. So the value of the firm comes down on X date. All right. What's the beginning value for August? Yeah, it's going to be August. It can be July 31st. Okay, what's the ending value? So we go to the end of August. 162.61. Sorry. And that becomes the beginning value for September. And then the income, they did have ex dividend, 57 cents. And then the ending value for September 29th, 159.93. and no income. So the holding period return, remember, again, it's ending value minus beginning value plus income divided by beginning. All right. Here we take ending value, which was 159 minus beginning plus income divided by beginning. So they're up $2. So that looks like a pretty decent month for them, up about 2%. I can't remember what was happening in July anymore. It's been too long. The next month, even better. They ended up another $3, which is pretty impressive. And they have a dividend, that's real impressive. Because they're up $3 even though they paid out 57 cents. So they're really up more than up like 357. Divide that by the beginning value, really strong month again. And then they had a week, September, which I think most people did. So if I did them, hopefully I'm doing these in the right order. I'll have to go back and check. Lost 2%. Gave it back. Let's make sure. Yeah, so up 1, up 2, minus 1. So a little bit of volatility there. The X date on the exam, we'll do a practice for a team competition, but on the exam, I'll give you the declaration date, the X date, and the payment date. So just make sure you whatever month is the X date, that's the month the dividend goes into. All right, you don't have to worry about anything other than that. All right, pretty straightforward. Does it matter that we put that dividend in the right month? Is that material? Well, here's a company, Choice Hotels. We go back to 2012. So in 2012, there was a thought that Congress is going to radically change the tax rates on capital gains. We had a discussion at UTSA about, hey, should we, well, I guess I didn't have, not in 2012. The same thing happened a few years earlier. So people were discussing, hey, should we distribute more this year, increase the capital gains, and then if the rate increases next year, our customers will pay a lower rate. So Choice Hotels saw that and they said, you know what? Let's do an unusually large distribution this year. And let's see if y'all see it. There's an 18-cent dividend on a $35, $33 stock. Doesn't sound all that extreme. There's an 18-cent dividend. Doesn't sound all that extreme. What about that? $10 dividend. That's a pretty big dividend, isn't it? What happened to their stock price? Their stock price went from $43 to $31. We owned the stock when this happened. And I remember I pulled up Choice Hotel and my word, we just lost 25% of our money. What did we do wrong? Did I lose 25%? No, the stock price went down about $11, but we got a $10.41 dividend. There's hardly any movement there at all. What happens if you calculate returns and you don't adjust for that dividend? You're going to look like you did horribly, right? And it's not that big of a deal. So sometimes it can be really, really material. There's other firms like that. Costco is kind of interesting. Oh, I hate it when you're trying to click on something, everything is moving around. So here's Costco. So $1 dividend, 90 cents, 79 cents, $10 dividend. Costco does that all the time. So for some reason, Costco prefers to pay massive dividends than buy their stock back. I don't really understand that one. If you get your data from Capital IQ actually reclassifies this as a stock buyback and not a dividend, because $10 is a lot of money. But if you don't adjust for that, you're going to think you lost a lot of money on now. Costco stock's so high, $10, it's still not that massive. You know, it's kind of puny that a stock with a $500 stock price is paying you $1 in dividends, but you know, $5, that's like a 1% yield. It's not great, but it's not much. But $10 on a $500 stock, that's a pretty significant to do all at once. So dividends can be very, very material. Let's see what industry. Let's look at NVIDIA. Let's do NVIDIA. Let's do NVIDIA. Let's do them March, February, and January. How much in dividends are we going to see? None at all, right? All right, so what's their beginning market price? So what do we need there? December 31st. December 31st, the stock price was 146.14. The end of January, their stock price was 195.37, which you all know because you all had NVIDIA in your portfolio, so that was nice. That gives us a beginning value there. What's their ending value in February? February 232.16, which you all know. And in March, they did pay a dividend, 4 cents. Big deal. Why did it even bother? 277.77. And they paid a whopping 4-cent dividend. There's some companies I'm like, why do you bother? 4 cents. What is 4 cents divided by 277? Yeah, it's 1 basis point. You can annualize that to 4 basis. Do you need a company to pay you 4 basis points in dividends? It's like, what are they even bothering? I'm not sure. All right, so that's a pretty strong stock, isn't it? 33, 18, 19. That's 3 months. That's not 3 years. That's 3 months. So you would have essentially doubled your money if you really do it, because plus 1 times that times, and then you make on top of that, there's compounding. We're going to talk about that here next. Your $1 would have turned to $1.90. 90% higher in 3 months. If they could keep that going for the next 10 years, they would be worth $1 trillion to the trillion power or something crazy. It would be an impossible number. All right, pretty strong. So y'all see how holding period, you just got to plug the numbers in. It's a really easy question. Key is just to know how to do the basic calculation. So modified Dietz is a lot better. The difference with modified Dietz will give you essentially the same answer if there's no cash flows. If you're not buying stocks, modified Dietz does that 4 cents or the whatever Walmart was, it will adjust that from when in a month did you get it. But other than that, it should give you the same answer. And especially on the 4 cents, you're probably not going to notice that they paid it on one day versus another. But modified Dietz, if you bought more shares in February, modified Dietz will adjust for that. So it's a little more complicated formula, but it's not radically off from what we're doing here. I could have done Meta in 2022, and then you'll see that 60% drop. All right. So that's return calculation for 1 holding period. We did 3 holding periods there, right? 3 months. So the question is, how do we take those holding periods and convert it into something we can get information on? So I wish I could do the exam in Excel so we could do a whole lot more in just 3 months. But we can do Excel in the class. So what company do you want to do? Why don't we try Meta? So I'm going to do historical prices And I'm going to do monthly. I'm going to go back a long way. And I don't want dividends, I want prices. And there's a little download button here. Be careful on markets. If you do this S&P here and do historical, notice there's no download button. All right. But if you do SPX, it does have a download. All right. So SPX gives you the download, the GS whatever thing doesn't. So if you're missing a download, just use SPX instead of the GS one. All right, so we got Meta here, so we can download all this. We got it monthly. Why monthly? Because that's pretty standard the way most people do the data. Daily gets really, really messy. I'm always confused on Columbus Day because I'm like, what's open, what's not open? So the stock market was open yesterday. The bond market wasn't, but it looked like it was because there were exchange traded funds that trade on the bond market, so you could actually see. So it's just a bizarre. I don't know how many times. There's a few days where the stock and bond markets, one's open and one's closed. Doesn't happen too often. So it gets kind of confusing. So here we have Meta. We don't need volume. So the question is, do we want anything? We don't need open, high, or close. So we'll delete all of that. So the question is, do we need close or adjusted close? So you're going to see when you do paper 3, you want to do adjusted close. What the adjusted close does is it assumes if they pay a dividend, you reinvest that dividend into the stock. So it adjusts that price for the dividend. May not be a big deal for Meta because they don't pay dividends, but for Choice Hotel, if you didn't do that, it looked like you lost 25% when you didn't lose 25%. All right. So that adjusted close, if you looked at Choice Hotel, maybe I can show you that real quickly. I shouldn't have taken it down, but I think I can get back to it. Oh, I think this is the one. All right. All right. Well, anyway, if you look at it, I don't know why I lost it completely. All right. Well, if you look at it, what you discover is that the stock price fell $10, but the adjusted price didn't hardly change at all. And that's because they go back all the periods prior to that and adjust it for that $10 dividend. So that you don't see that big change. So that's important because in paper 3, you're going to come up with a beta for your stock. And you don't want the beta calculation to be distorted because they paid some big dividend. All right. We'll see that. So adjusted close is what we want. Adjusted close is really, really good for stocks. You really cannot get a really good total return by using adjusted close. It doesn't work for mutual funds. We talked about that earlier. A mutual fund pays a capital gains. Yahoo Finance doesn't adjust for that. It does adjust though for dividends and stock splits, so you'll get a true return. All right, so this is Meta. So it starts in 2012. So we're going to do a holding period return. Holding period return is going to be ending minus beginning, income 0. Even if they pay dividends, income 0. Why? Because the adjusted price adjusts for dividends. So if you use the adjusted price, it's as if you're including the dividends in there. So that's not an issue. Divided by beginning. So they started off their history with a negative 30%. Why? Probably they went IPO and their IPO was exciting. And then everybody said, wait, this is never going to go anywhere. So there's their monthly return. Holding period returns. Wow, they started off pretty weak there. Had a really great month there. There's 2022 where they lost 50% in a couple of months. Wow, really, really weak. They started 2021 at $336 and ended up, they actually fell below $100, ended up at 120. That's a pretty bad year for just about any stock. All right, so this is a bunch of holding period returns. So what can we do with this holding period return? Well, we can take an average. And what average we're going to use? We're going to do an arithmetic average. Arithmetic average is real simple. You just add up all the numbers and divide by n. That's real simple. That's the easiest average you have. So we can use the average function. And their average is 234. That sounds really bad, but is that bad or good? These are monthly returns, so that sounds really, really good, right? That's like an average of 24% in a year, maybe. So there's your arithmetic average. Can you annualize this? How would you annualize arithmetic average? That's monthly. How many months in a year? 12. Yeah, you actually can just multiply by 12. All right, so that's real simple. So that's one type of average. There's another average called the geometric. And I don't know why one has a R in it and the other one doesn't. But anyway, geometric average. I've looked and looked, and someone says Excel has a formula for this. I've never been able to find it. But let me show it to you, kind of thinking as an investor. Let's say you had $1 to start with, all right? So if you started with $1, how much would you have at the end of the next month? You have $1 times 1 plus that, you'd be down to 70 cents. All right, you take that 70% and you lose another 16%. So now what do you have? I got 58 cents, but then you make some money. Geometric average is what we're calling, you geometrically link all returns by taking 1 times 1 plus the rate times the previous. You just keep linking it until you get to the very, very, very end. So if you'd had $1 in 2012, how much would you have as of September? Or I got this through October. What do you think? $2, $3, $4? Do you wish you'd bought a bunch of Meta stock? I mean, you lost almost half your money after 3 months. That sounds pretty bad. How much would it be? How about $10? If you invested $1,000, you'd have $10,000 at the end of that. So that's pretty good. So what is the geometric return? The geometric is the linked monthly raised to the 1 divided by number of months minus 1. And if you're not familiar with this formula, learn it, because you're going to use it. Well, I wish I could count every single time I use this formula. It's got to be in the millions. Because I had spreadsheets with 40,000 things in them where I'm doing this calculation over and over and over again for every single one of those 40,000 things. So it can be massive number of times. It's a very popular formula. So the monthly geometric, this is monthly. One thing I can say for sure is that it's less than something. What do you think it's less than? Any guesses? It has to be less than a number on this page. Obviously, it's going to be less than 20%, but that's not the one I'm talking about. The geometric has to be less than what? Has to be less than the arithmetic. All right, so let's see if that's the case. So let's see, how many months do we have? We don't count that very first month. All right, we started from how many months where we had it invested. So there's 136 months. So my geometric is going to be my 1041 divided by 1. Why 1? Because I started with $1. Raised to the 1 divided by 136 minus 1. Ooh, I did something wrong. Oh, 1 divided by, excuse me. And that gives me 1.72%. Is that less than 234? Good. All right. So you do make your one thing. You're going to see when I do an exam, you can see why I don't give you 136 months on the exam, because you have to do it by hand. But if I could give you an exam in Excel, we would do it like this. How do you annualize? I'm not yelling at you, but annualize. Aha. Anybody know that formula? It's this formula again. We just got to change one number. How many months in a year? 12. 12. Where would the 12 go? Minus 12. That would give you like negative 11 point. 1 divided by, right? Instead of 1 divided by, we're going to do 12 divided by. Now, can this be higher than arithmetic? Yes, in this case, it can be. Because we're annualizing a massive number. So the arithmetic is not compounding. It's just multiplied by 12. The geometric is actually compounding. Compounding can give you a massive number. So it can be quite a bit higher. In this case, it's not, but it can be quite a bit higher. So you just raise it to 12 divided by 1. All right. So what can we do with this information? Well, knowing this is the better number. This 172 is the better number. Let me show you real quickly why that's the case. So let's say your uncle comes to you, you see him at Thanksgiving, you're talking about the class, like, wow, you learned a lot. I'm going to give you $100,000. Why don't you invest it for me? You say, okay, I'll do that. So you start on time 0, got $100,000. And you do month 1. Let's say you make 50%. Your uncle's like, my word, you're really, really good. So you're up to $150,000. He's pretty happy. He's like, wow, I made a good decision. Month 2, you lose 50%. So 150,000 times that, you have $75,000. Now you need to report out to your uncle. So what is your arithmetic? So you take 50% minus 50% divided by 2, and what does that give you? 0%. So your uncle started with $100,000. Now he has $75,000. Hey, uncle, it wasn't too good. You made 0%. Is he going to buy that? What do you mean 0? I would have loved 0%. You lost $25,000. What's the geometric? Well, the geometric is going to be 1 plus 50% times 1 minus 50%. We're going to take all of that and raise it to what? 1 divided, how many months do we have? 2 minus 1. The geometric says he lost 30. Which of those numbers is he going to, that his average, say, well, those could be years, but what was his average monthly return? Was it 0% or minus 13%? He's going to take the minus 13%. That's going to make more sense. So which is the better number to use? And the answer is yes. When to use the geometric, when you're looking at historical returns, the geometric is going to tell you your true return. It's kind of like an IRR, like you did with net present value and all that. So that's your pre-return. If you're forecasting in the future, the arithmetic is actually the best forecast. If you want to make, let's assume we have good statistics and we only have 2 months, but we had a lot more months. If you're trying to guess what he's going to get next month, 0% is the better forecast. So arithmetic's the right answer if you're going into the future. Geometrics if you want to know your actual return. All right. So geometric, I use geometric in my own portfolio to get my actual return. But if I were forecasting it out, the arithmetic would make more sense. And that's the key between these two. I think I gave you the formula somewhere in here. I can't remember. Yeah, here it is. So how can you equate the two? If it's a fairly normal distribution, the geometric is going to equal the arithmetic minus half the standard deviation squared, or minus half the volatility. So the more volatile something is, the more those two numbers are going to be very, very different. Okay. So arithmetic minus half the volatility. So let's see if we can do this with the standard deviation of this stock is 11%. So if we take the arithmetic minus 0.5 times the volatility, it gives us 1.72. How close was that to the actual geometric? Pretty close. So that means Apple must be, or Meta must be somewhat normally distributed. All right. So the more volatility you have, the more those two are going to get off. And you saw that with your uncle, right? Because arithmetic was 0, and yet you really lost 13 a month. And that's because he had a lot of volatility, right? That's pretty volatile portfolio, 50% up, 50% down. All right. So this is a good formula to keep in mind. If this formula doesn't work, the geometric is not that relationship, there's a good chance you're not dealing with a normal distribution with some skewing there. So if you're doing options, we'll talk about options later. Options are not normally distributed. They're very skewed. That formula would not work. It works really well for stocks because they tend to be fairly normally distributed. All right, we'll practice with this more. Thursday, we might work an actual exam question on the holding period so you can see it. You can see that kind of how it works together. Now, one last thing you got to put in here, put it on your exam. This is like easy points on the exam. On the exam, I only give you 3 months, and you're going to annualize them, but you're not allowed to do that. On the exam, you are. But the CFA Institute, which is our kind of our regulatory board or our trade association, you can't annualize anything that's less than a year. You can't annualize 2 months or 3 months. If you got 10 years, you can take the average and annualize that. But if you only have 3 months, you can't annualize it. Now, if you go on the Bloomberg machine and you bring in 3 months of return, they do annualize it, but you're just not supposed to do it. So on the exam, you're going to do the 3 months, you're going to annualize it, and you're going to put a footnote so CFA doesn't allow us to annualize it. We'll practice that a little bit more, but remember that. All right, that's it. I'll stop a little early. All right, so this is the last time we talked about the exam, so I'll put exam question 1, I'll put it on Canvas. If I haven't already, I guess I haven't yet. I'll put it on Canvas as an assignment before probably this week and sometime. So you just submit it there as an essay in Word. And in question 2, we'll do in class the first 30 minutes on Tuesday. So your essays due 2:30 on Tuesday, and then we'll do the question 2 in here in class. And then we'll have class after that 30 minutes. Just a reminder, I know it's going to be a disaster for some and it's going to be an ace for others. This is one of the most barbell exams I do. It's like some people get it, some people it's like the exam's not next Tuesday. I'll start working on it at 2 o'clock on Tuesday. It's a little late. It's essentially a paper, isn't it? Question 1, it's not really even an essay, it's really a paper. So if you've been writing it every week as we go, you probably are done and you have no problem. If you haven't been, you got a really heavy weekend this weekend. And if you haven't gotten far, I still recommend you read the class notes, listen to the video, read the class notes, and type off the top of your head, but go piece by piece. So if you're doing DC cuts I, do D, then do the C. Do it so it's because you can't listen to the entire thing and write off the top of your head. Do I want mediocre answers or great answers? What do you think? Great answers. Yeah, I want great answers. I don't have this. I'm trying to scare students away because some are just COVID has just been such a disaster. But let me scare you to death. From ages 18 to 25, this defines about 97% of the next 50 years of your life. Extremely important years. And if people are doing mediocre things, guess what the next 50 years of their life are going to be? They're doing great things. Some of you are there last night, right? Cody was there last night. What is Tim Hanner thinking about mediocrity? Do you think? Is he a big fan of mediocrity? No. Pretty impressive guy, right? Great guy, friendly guy, really very personal guy, but also like we're gonna take over the world. Are you coming with me or not? Kind of person. That's what you should all be, because you don't. When you turn 70, you can't say, you know what, I'm going to do that all again. I could have done a lot better in Professor Sweet's class if I had just done that. You only get one shot, so I want great answers. Just to remind you, an exam example I gave you last time. You know, it's the notes. What's the portfolio? Why are you investing? And what can you invest? Don't say, what are you investing? That's kind of a strange question. I'm investing my money. In what can you invest? And then how are you going to execute? And then the what is the rest of that answer. You go bonds, cash, stocks, and alternatives, and you got to contrast bonds versus cash. And then bonds, you do DC cuts I, you got to define duration, you got to give me the 3 categories and give me the strategy all the way down. All right. So, I mean, this is a 5-page answer here. You probably could go much longer than that. They could have organized it better, break it up, definition, subcategories, strategy. I make that each a paragraph just to keep it straight. But this is what we're looking for. So I want great answers. I don't want mediocre answers. Some students I've seen last semester was kind of interesting. Some students were like great for the first 70% of the paper, and then they got the equities, and it's like, I got tired, I ran out of gas or something. And it's like, why did you stop there? I don't know if they just started too late. You really should already have your essay written, and you're ready to submit it. You're already done. So that's what you should have already been doing it. But yeah, remember on stocks, you're gonna have an introduction to stocks that talk about what a stock is before you get into beta. And the same thing on the stocks. So on beta, you got to define what it is. What are subcategories? There's cyclical and defensive stocks, and what is your strategy all the way throughout, right? Questions on answer 1? Question 1, I mean. And then we talked on the question 2. There are some students that get like 85% on 1, and in question 2, they get like 5%. Because they think it's like it's a true false. Underweight, overweight, overweight. They hope they guess, and if they're worst case, they get 50%. But if you say underweight, you get 0 credit, even if underweight's the right answer. So you have to say underweight and why, and you got to be real explicit. So you can't say underweight short-term treasuries because expect a strong economy. You got to talk about the economy and interest rates. Remember, there's 2 things there. So how many bullets we have at a minimum? 6. At least 16, and then probably 1, 2, 3 extra for alternatives. All right, so you should have 16 bullets, including this first one, which is not on the list, right? Stocks versus bonds. I usually start with that one. So you got to give me why, and make sure you break it up clearly on the why. A good example is stocks. Don't say I want to overweight large cap. Within stocks, overweight large cap, low beta stocks because of recession. That's true. But are you overweighting them because they're large cap or because they're low beta? Well, it's both. There are really 2 asset classes in there. So that's why I say have 2 bullets. Talk about the large cap, talk about the low beta. All right. I'm not going to give you a question where they contradict each other because I'm not going to give you large cap, high beta. That's going to be confusing. So I keep them consistent. All right. I think this is an easy question, but some students, this is just so out of their norm for a class. They just freak out. You can't handle it. But you should be able to handle this. There's nothing on this that you shouldn't know, and you're going to see it in interviews, and just have to know it. Questions on that question? I haven't written the question yet, so I don't know what my view is going to be on. So we got some unusual conflicts around the world. We still have inflationary numbers. I was trying to show you all the jobs report. That was a really strong jobs report. I don't know if y'all noticed that. And the stock market did what? Sold off and then came back. The bond market has done what? Until today. Huge rally, right? In bonds, and then today it's selling off again. The CPI number came out today. It didn't look all that spectacularly surprising one way or the other, and yet who knows what markets are interpreting. So I don't know what I'm going to write. I'll find some way to write it. Okay, so I'm looking for the day where the whole class aces the exam, but I doubt it. There's a lot of students in this class that have missed so many classes. Most of y'all have been here, but yeah, it's. I remember one student coming in a class, and he's like, "What are we supposed to do? What are the questions we're supposed to ask?" And I was like, "Sorry, I can't help you. You essentially want to give them the entire essay." And that's when we did it in class. Y'all have the advantage of doing it outside of class. So blow me away. I want great answers. All right, so we're talking about measuring return and risk. So I want to do something today just to remind you of what you already know, but to make sure you're really comfortable with it. So with Meta, it did their arithmetic monthly return, which is the average of all those monthly returns. We annualize that. You remember how we annualized it? Arithmetic, multiply by 12. In geometric, more complicated, we had to link them all. And then we had to take that to the 1 over n minus 1. And to annualize that, you do it to the 12 over n minus 1. And you know, geometric is always going to be lower than arithmetic. And I showed you that by taking the arithmetic minus half of the standard deviation squared, and that got me really, really close to that number. So when did y'all take statistics? And did you know it was your most important class of your entire college career? Was it last semester or 2 semesters ago? Has it been a while? Did y'all take stats before 3013? Before, all right. Did they tell you how important it was? Was it taught by the math department or the business department? Was it a business stats class? Like they showed you some good. How much do you remember? We'll find that out today. All right. So in finance, there's 4 statistics we use an enormous, well, probably 5. So we do the mean. Y'all know what the mean is. What's another word for the mean? The arithmetic average. So standard deviation, correlation, R squared, we talked about that earlier, and beta. So of these formulas, which ones should you know off the top of your head? All of them, off the top of your head without even thinking about it. It's just be second nature. So I don't know what you did in your stats class. In my stats class 90 years ago, we had to calculate all this stuff by hand. We didn't have calculators that we calculated. We had to do everything by hand. It was just number crunching. There was no Excel, so it was just writing on pieces of paper. So it's pretty intense. Today, you have the calculator does it for you, but you need to be able to calculate it yourself. So I have Meta in here. I have the S&P 500. So the mean, we already did that. The mean is just the average of the monthly returns. So that's that 231 we've already seen before. We can do the same thing with the S&P 500. So the S&P 500's monthly return is 0.94%. Meta's 231. That's just the average of all those monthly returns. That's pretty simple, isn't it? So we know what the average is. The average, the mean. What's the median? Is that the same? No. So the median is what? It's the 50%, right in the middle, right? When do you use median? I like to use median if they have a really skewed population. I want to know what's that 50%. Because the average can be skewed by outliers. The median is not skewed by outliers. So if you have a bunch of 1% and then some of these are 90,000%, that 90,000 is going to really skew your average, but the median just ignores it because it's not in that 50%. All right, standard deviation. So I even asked you, I remember this? Anybody remember standard deviation? Let me give you some hints. All 4 of these formulas look almost identical. So you take a difference, multiply, and then take an average. Go on those steps. Take a difference. The first thing is the difference. That's really important in finance, that everything is a difference from what? What is the difference from? From the mean, right? So that's pretty key for finance. Everything in finance is how far away you are from the mean, which is also known as the mean, the average, also known as the expected value. So the S&P 500's mean is 0.94%. How many months do we expect the S&P to make exactly 0.94%? Probably never, but we call that the expected value. Why do we call that expected value? So for some reason, someone said expected. We don't expect it. We just expect it to be the average maybe going forward. But real key in finance, our definition of risk is how far can you be from the expected? That's a pretty critical concept because not a lot of people, that's intuitive for them. You tell your uncle, well, we'll talk about standard deviation, but you tell your uncle, you know, his portfolio is up 50%. You say, wow, that's really risky. And he says, risky, I just made 50%. Well, why do we say that's risky? That's the average is 2%. He's up 50%. So if he can be up 50% when the average is 2, what else could happen? He could be down 48% when the average is 2. But most people don't think, you know, I'm up 50%. What risk is that? Well, because the other side. So we tend to think symmetrically with these. So for the standard deviation, the first thing we're going to do is take the difference. So for Meta, we're going to take that first month, 0.3, negative 30%, and subtract their mean. Pretty far from the mean there. We do that all the way down. Same thing with the S&P 500. We take that return minus the mean. Copy that all the way down. So for standard deviation and for correlation and for beta and for R squared, that's your first step. Y'all remember doing that in stats? All right. So what's the second step? We're going to multiply. Well, in standard deviation, what do you multiply? You multiply that difference by itself. You square the difference. You remember that? How many negative numbers do you get? None. So standard deviation doesn't care about whether you're above or below. What does it care about? How far away from the mean. Now, correlation, R squared, and beta, they do care whether you're above or below. But for standard deviation, all they care about is how far. So we're going to square that. We'll get rid of all those negative numbers. And then the last thing we do is just take the average. Average of those squares. Oops, went too far. Same thing with the S&P. Oh, how did I get a negative number? I'm on the wrong.
Negative in the average. When you type the average.
Yeah, I type it wrong.
Yeah.
Oh, all right. Well, I was kind of worried that the math has changed. How do we get a negative number? All right, and we have to do one last thing. Take the square root of that. So that's the variance, or that's the volatility, right? You remember volatility? All right, so there's their standard deviations. What if I want to annualize that? What do I do? Remember in stats, if you have volatility, you annualize that just by multiplying by 12. But this isn't volatility, it's the standard deviation. So we don't multiply by 12, we multiply by the square root of 12. All right, so that times 12 raised to 0.5, that's their standard deviation annualized. So the S&P's annual standard deviation is around 15%, Meta's around 38%. Now I did do it right, maybe not, we'll see. It's kind of tough when people are staring at you to get things right, but let's see. Does that look close?
Yeah.
Now, why do I use STDEVP, not STDEV? Because STDEV divides by not n, but by n minus 1. There's that 1 degree of freedom. So the p will give me the exact same number because I didn't divide by n minus 1. I just divided by n. All right. Same thing with the S&P. I don't know why I did. That looked pretty close. All right. So standard deviation, pretty straightforward, but the main thing to do is think about what it's doing. It's taking each of those months and seeing how far it is from that average. And then squaring it, so the negative numbers move away, but what else happens? The ones that are really far away get a huge impact. The ones that aren't very far, so it's really skewed by the outliers. Outliers are really important for standard deviation. So some people, when they get a year like October 8, 1987, you get that big month where the market falls 20%. They say, well, leave that out of the data because that's too unusual, because it's going to really skew your data. Change your. I don't have 1987 in these numbers, but if I did, 2008 is 2008 is not in these numbers. I don't think. How far back did I go? Yeah, 2008 is not even in these numbers, so that's probably why the S&P standard deviation is so low. So do you kick out those outliers and assume they never happen again? So very sensitive to outliers. So step 4, well, let me copy this down. So step 4, take the square root. So that's standard deviation. Higher means what? You're more likely to be really far from the mean. Which means you're more likely to be really surprised. A bond might have a standard deviation of what? 0.3%. The S&P has a standard deviation of 4%. Meta is 11%, and we're going to see that later. Stocks are going to be much more volatile than the stock market. Why? Because of correlation. The next thing we're going to look at. All right, is this coming back to y'all? You know how to do this? You might think, well, everybody knows this, but a friend of mine was in graduate school, and there was these graduate students, finance graduate students, they were trying to take the standard deviation of one number, and they were having trouble doing it. What's the standard deviation of one number? What's the average of one number? That number, you take that number minus that number and square it, and then take that divided by 1 and take the standard square root of that. What are you going to get? Probably 0, right? You might even get, I don't know if Bill Gates would even give you a number. We can try it. You can't do STDEV because then you're divided by n minus 1. I wouldn't think. We'll see if Bill Gates will let me do it. Yeah, you can't do that. So, but these are graduate students in finance trying to figure out standard deviation of one number. So see how far ahead you are. I remember on a CFA exam, I was in a review class on the last day. CAPM is to me so easy, and they ask a bunch of questions. The last day, these two guys in the front, it's like, wait, what's this CAPM thing? What is it? And it's like, oh, good. I think I'm in good shape. So, you'd be surprised. People that have been in college for years in finance don't remember these basic formulas. All right. So correlation, you take the difference and you multiply, you take the average. The difference here is you need two things. So here I'm going to have meta, I'm going to have the S&P 500. Okay. So I already have the differences, so that's already done. So when I multiply now, what do I multiply? I don't square it. Instead, I'll do what? I multiply meta's difference by what? The S&P 500's difference. Can I get negative numbers there? And when do we get negative numbers? So this is real key for correlation. If S&P and meta are always above their average at the same time, and always below their average at the same time, what's correlation going to give me? Positive number. If meta is above when S&P is below, and opposite, you're going to get a negative number. So you see what correlation is looking like? People say, do they move together? But that's not correlation. Correlation is how do they move relative to their averages? Are they both above their averages at the same time or below? So if meta's average is 2.31%, and they're up 1%, and the market's 0.94, and they're up 1%, you say they're moving together, but not. Meta's below its average, the S&P is above its average, so you get a negative number, all right? So it's, remember, correlation, it's relative to the average, all right? Then we're going to multiply that. So let's do that. So we're going to take the difference, that's that second column, times the difference. We'll copy that all the way down, probably too far down. So there's my difference. So I have negative numbers, I have positive numbers. So I've taken a different multiplied, then I do the average of those multiplied differences. And then there's one last thing to do. I mean, what the last thing to do is? Here we're gonna, the last step, I'll give you a hint. we're gonna divide. Anybody remember what you divide by correlation?
Whatever root of the summation of your x minus your x bar times your y minus your y bar, they're both squared.
Yes. So when they're not both, I don't think they're both square. We'll try we'll try it.
Yeah.
So you divide by the standard deviation of meta times the standard deviation of the S&P 500. All right, let's try it. I got it. So there's Meta's returns. There's the S&P's returns. Does that look pretty close? All right, so it's now anybody know what that numerator is called? The differences multiply the average of them. You know, it starts with a C. It's not correlation. Covariance. That's the covariance. All right, that's important because when we do beta, we're going to use covariance again. All right. So what's the correlation for the S&P 500? Yeah, we can't do that because we don't, you know, you only have one combination here. So, all right. So the correlation between the S&P 500 and Meta is 0.41. What's the R squared of Meta versus the S&P? How much of Meta's volatility is explained by the market? Yeah, you just square it. So I don't do percents on correlation. I only do percents on R squared. I don't do percents on beta. I don't talk about some having 90% beta. Betas are 0.9, 1.3. Correlations are 0.7. What's the highest correlation you can do? 1.0. What's the lowest? -1. R squared?
1.
0 to 1, right? You can't be negative because you're squaring it. All right. So only 16% of the volatility of Meta can be explained by the volatility S&P, which means when you put Meta into the diversified portfolio, 84% of its risk disappears. That's pretty cool, isn't it? You have 50 stocks and you add Meta, 84% of its risk disappears. That sounds like really, really powerful. And that's what that's telling you. 16% doesn't. All right. So what is beta telling you? It is telling you how sensitive that 16% is to the market. Right? Have y'all had beta before? And these three you have, 4 of you have. So that's what beta is telling you. 16% of the volatility of Meta is explained to the market. Of that 16%, how sensitive is it? If it's really sensitive, the beta is going to be like 1.5. If it's not very sensitive, the beta is going to be pretty low. Okay. So R squared is easy. Just do that. And guess what beta is? Of what? So beta measures only systematic risk, which is the market risk. What risk do we have up there? We have metas and we have the markets. Which S&P? Which of those is the market risk? S&P. So we don't want beta, we don't want meta's risk in there at all. So watch this. I'm going to take that correlation formula. Instead of multiplying it by the risk of Meta times the risk of the market, what I want to do? I only want the risk of the market. Okay. Now, how high can beta be? Can beta be above 1? Can it be above 10?
Yes.
Can it be above 1 trillion?
Yes.
Yes. How hard is it to get it above 1 trillion? It's not that difficult. Borrow a lot of money, buy call options on the S&P 500. Your beta will be really, really high. All right, so their beta is 1.1, which means how much more systematic risk do they have versus the average stock? About 10% more systematic risk. But that only applies to what? 16% of their risk. 84% of the risk is specific to Meta. And what does it do when you put it in a portfolio? It completely disappears. So how much should you be compensated for the 84% risk? According to CAPM, nothing. You shouldn't get any payment for that. You should only be compensated for that 16% because 84% disappears. If your risk disappears, how much you should be compensated for that risk? 0 risk, you should get paid 0. All right. So the beta for Meta is 1.1. We can check this one. Use the word slope. Here you have to be careful. You have to put your stock first and the market second. All right, or you'll get a strange answer. So the slope of the returns of Meta, there's Meta's returns, versus the returns of the S&P 500. Does that look close? Looks pretty good. I strongly recommend all of y'all do exactly this if you can. How many of y'all can do this without any notes? Kyle says, anybody else? You know, do this whole thing, not looking any of it up. Your finance major or an actual major, that should be, without even thinking, you should be able to do that. Those are the most important formulas. We use them over and over again. You just got to know them, but they're pretty simple, aren't they? Difference, multiply, average, and then take the square root or divide by standard deviations. They're really, really simple formulas. But everything is driven off of one big number, the average. So in finance, that expected value, that mean is just so critical. Everything we think about risk. So is it correct? There's a lot of debates. People think we should be using semi-variance. We should be using kind of, tail analysis, other things, the stock market's not necessarily normally distributed. It's pretty close. The problem, and if it's not normally distributed, these ratios don't work. So the market is generally standard as normally distributed, except for in the tails. In the tails, it goes crazy. Things happen in the tails that shouldn't happen according to our math. Which is one thing I hate about these statistics. They work really, really well unless you really, really need them, and then they fall apart horribly. It's kind of terrible. It's kind of like having a fire extinguisher that works unless you're in elevated heat, and then it just stops functioning. That's kind of the measures we use.
Yeah, it's the problem with like predictive models. They can only, by definition, predict things that are predictable, but not unpredictable.
Yeah, and it's tough when you have markets down 10% in a day. And these statistics say that's mathematically impossible. If you have 7 trillion years to the 7 trillion power, it would never happen. And yet I saw 4 days in 1 week during 2008. So at the extremes, it doesn't work well. That's the big problem. If you read Caleb's Black Swan, he thinks we're making a mistake using statistics because risk to me is in the tails. It's those extremes. That's what I worry about. I'm not worried about normal volatility. I'm worried that the world's coming to an end and something wild's happening. That's an extreme. These statistics won't help you with that at all. So there's a lot of people who don't think we're using the right type of measures, but it's the measures we use quite extensively over and over and over again. So this is really your statistics for finance is these numbers, more than any other numbers. All right. So let's talk. So we did return. Get rid of this thing. So holding period return, probably on a monthly basis, and that's what you'll do on the exam. Probably on Tuesday after question 2, I'll show you the exam questions on the return. Pretty straightforward. Most students have no trouble getting that correct. So holding period return. Once you get the holding period return, then you're going to do some averages. So one month's not going to help you. You need a bunch of months together. On the exam, I'll only give you 3 months just for the sake of time. But you can do an arithmetic average, you can do an annualized arithmetic average, a geometric, annualized, and then you start calculating things like standard deviation, beta, correlation, those type of statistics. But to do those statistics, you're going to have many months. You can see with Meta, we had about 10 years worth of monthly data, so 120 points. That's pretty good data for us to look at something. But if you want to do Walmart, you can go back to the 70s. So you're going to have decades and decades of data. There's plenty of data out there to do these type of calculations. The other thing we're going to see on paper 3 is not just doing the calculations, but actually looking at how stable they are over time. And those are my business finance class. We did that in our class. If you remember the rolling beta. So we're going to look at it because betas are not as stable as the theory suggests. So we'll look at it over time. Same thing with standard deviations. They're not very stable. They're up and down, up and down. So what number do you use? If you use a high number, then you're going to tell your customers never buy stocks. You use a low number, you can tell them put everything in stocks, and then 2008 happens and they're really shocked. So what do? You just take the middle. If you use the middle, then you're wrong when markets are great. You're wrong when markets are horrible. So it's tough. It'd be nice if these numbers were nice and flat, but they're not. They change quite dramatically. All right. You should know these backwards and forwards. It does assume a normal distribution. So y'all know these formulas? Can anybody tell me these formulas? No, off the top of your head, y'all got it? 100%. I wish on the exam I could just give you two databases like Meta and S&P, and you do all these calculations by hand. The nice thing is in Excel, you can check your work, right? STDEVP, you got Coral, even R squared, even a form of R squared if you don't have to go to the square. And then beta is not beta, it's slope, SLOPE, and make sure you do your company first and then the market. So they're all in there, but the fact that you know how to do it in Excel doesn't mean you know the formulas. You got to be able to calculate them by hand and then check it against the formulas and make sure you got them. So standard deviation is a measure of total risk. So the standard deviation of a stock is interesting, but we don't usually use that in finance. Why? Because 84% of that risk is going to disappear for a minute. 84% of that risk is going to disappear. We don't care that the standard deviation is so high. Right? So standard deviation is what you use for your total portfolio. If you've got a portfolio of stocks, you can look at its standard deviation. You don't look at the standard deviation of the individual stocks inside. So think of standard deviation as total risk. It's the risk you look at for your total portfolio. Beta is what we call relevant risk for the particular stock. It's the measure of risk that you want to associate with your particular stock. Correlation R squared are used for other purposes, but they're interesting. Especially R squared is really interesting. As I showed you, the R squared tells you how much of the stock's volatility is beta talking about. For typical stocks, it's less than 20%. For most stocks, I was going to ask you all this question in class, but I'm giving you the answer for it. For most stocks, most of their risk disappears with diversification. 70–80% of the risk goes away. So beta is only looking at that small part that's related to the market, the risk. Why? Because if Meta announces something really, really big and they're up 12%, then Google's going to announce something bad, they're going to be down 12%. So those two company-specific things, they just offset each other. So when do we use correlation? We use correlation more if you're building like an efficient frontier, or you're doing something at the portfolio level. We don't usually use correlation with individual stocks, but the R squared to me is pretty interesting. Okay, questions on that? What did y'all do in your stats class? Did you do some interesting projects? I think if I did stats, I wouldn't do any exams. I think the whole class would be projects. Did y'all do projects in that class? Go out and survey, get some data. I mean, some pretty cool stuff you can do in stats. If you can't remember, read that book, Naked Statistics. They do a great job of reviewing everything you learn and then showing the application, what you can actually do with it. It's a great, great book. All right. So there's those formulas again. X bar just means the average. So difference, multiply, average, and then do the last part. So I'm going to argue these formulas like anatomy to a pre-med student. This is our anatomy. This is what we know off the top of our heads because we use it so often. So if you find someone in finance doesn't know these formulas off the top of their head, just imagine walking to the doctor's office with a pain in your side, and the doctor pulls out a book and says, "Let me see which side the appendix is on. I can't remember. What's your next step?" You're exiting the building, right? You're not going to say, "Yeah, I don't think I want you as my doctor." Oh, wait, I can look it up. If you have to look it up, you're not a professional. You have to look it up. You're kind of a weekend. So make sure you know them. So much of our theory is in there, especially this X bar. It's so critical. And you may find at Thanksgiving talking to your uncle or your aunt, they may not think about risk in those terms. They may think, I think most people actually think about risk is I lose everything. It's some massive catastrophe. 2008. We're not saying, oh, sometimes you're up 10, sometimes down 10, but on average you'll make 8%. Most people aren't worried about it. They're worried. If they're down 10, people say that's okay. It's when they're down 50, 60%, they're like, is the world coming to the end? And in 2008, boy, it was interesting hearing Tim tell his stories. My 2008 stories, I don't want to tell them because I have nightmares tonight, but 2008, what were y'all, like 7 years old then? Elementary school, maybe. So, but I don't know if y'all remember, y'all won't remember that one weekend. So we're going into the weekend, Lehman is toast. So the Fed's going to try to rescue Lehman. They get all these banks together and everybody said, now think about Lehman. Lehman is this firm entirely dependent on short-term debt. When you have to go to the market to borrow money constantly and the market no longer trusts you, you're done. But not only that, their balance sheet is incredibly complicated. And they have one weekend to figure out if they want to buy Lehman or not with these incredibly complicated securities. And they just say, no, we don't want to touch it. And so the Fed goes, okay, well, you're not going to touch Lehman and they go under. What about Merrill Lynch? Is someone going to buy Merrill Lynch? And people are like, no, we don't want to buy it. But the Fed's thinking, okay, Lehman goes under, Merrill Lynch goes under, Goldman's going to go under, Morgan Stanley's going to go under, Bank of America is going to go under, JP Morgan's, the whole world was going to come to an end. And that was that weekend. No one wanted to touch. Would you want to buy a stock, a company where you don't know if they're worth 20 billion or negative 80 billion? And you have one day to figure it out? You don't want to touch that. And so what happened that weekend? Bank of America came in and said, you know what? We're North Carolina bank. No one respects us. We get no respect anywhere. We'll buy Merrill Lynch. That was the big giant. They're the big sophisticated. Yeah, we'll buy them for $30. They could have bought them for like $2 the next Monday, but they said, well, thank goodness. If they had not done that, 2008 would have been, I don't know. Y'all wouldn't be here today. We'd all be, we'd be in the jungle, killing chickens or whatever. It was amazing that, and as bad as 08 was, it could have been so much worse. But thankfully, Bank of America bought out Merrill, and Goldman and Morgan survived. But those entities were all in horrible shape. I don't think there's any hope for Lehman. Barclays did buy out Lehman, but just the fixed income side didn't really save the firm. So. Yeah, that's what most of us think about as risk. I think that's the way I think about it. I don't mind up and down. This market right now, yeah, it's down 7%, but yeah, that's kind of normal. Who cares? That's kind of normal. But if it drops 50%, 60%, and people are panicking and all that, that's where you're worried that if we're going to zero and the world's really changing radically. Standard deviation doesn't account for the end of the world. If our sun blows up and becomes a white dwarf, your portfolios are all going to zero. Standard deviation can't account for that. Okay, so for portfolios, standard deviation is the right measure of risk. You've probably heard of the Sharpe ratio. The Sharpe ratio is the ratio you use for a total. You don't use a Sharpe ratio for an individual stock. The Sharpe ratio is for the total portfolio. Who's the Sharpe ratio named after? William Sharpe, right? Nobel Prize winner. His videos are out there. You can watch his YouTubes. He has some really great podcasts. I would highly recommend listening to William Sharpe. So standard deviation is a total risk. You're looking at how far you can get from the expected value. The higher the standard deviation, the more you could be surprised by being way above or way below. It is extremely sensitive to outliers. So really big days can have a huge, because you're squaring the difference. The difference is small and you square it, you get a really small number. If the difference is big and you square it, you get a really big number. So it really exaggerates those. And it doesn't matter if it's big positive, big negative, because you're squaring it. For individual stocks, standard deviation is incorrect because of diversification. According to William Sharpe, now he came up with this in the early 60s, about the time I was born. He was working on this. So Markowitz came first in the 50s. Y'all remember Harry Markowitz? He just passed away this year. I was doing a presentation this summer, and I was talking about Markowitz, and I said, I'm going to check and see how he's doing. And he had passed away literally the week before. I was like, that's really sad. Did y'all hear about his death? I mean, he's got big. He's another Nobel Prize winner. What did he invent? Y'all remember that? Starts with an E. Efficient frontier. I remember hearing that. So the efficient frontier, very data cumbersome, really tough, but interesting insight. William Sharpe comes along after him and says, I can simplify this greatly. So instead of correlating Meta to Google and Microsoft to Walmart, it's all these correlations, but forget about that. Just do Meta to the market. Do Walmart to the market. Just do everybody to the market. That cuts your correlations down dramatically. Because if there's 500 stocks, you got to do this stock, the other 499, the second stock, the other 498. That's a lot of correlations. But if you do it against the market, you only need 500 of them. And that's what William Sharp came up with the capital asset pricing model, or CAPM. So what William Sharp is asking is, when you're looking at an individual stock and putting it into a portfolio, how do you measure its risk? And what he said is there's relevant risk and there's risk that's not relevant. What he says, those two risks are systematic risk and unsystematic risk. Systematic risk is the risk you care about. And that's where you want to see on that systematic risk for Meta, how much was their risk systematic?
10%.
Or I don't remember the number, was it?
It was 1.1.
16?
Around that.
Well, okay, but what percentage is that? So yeah, I mean, that's a good point. So we're looking at, and I had to hit escape again, sorry. So what percentage of their risk is relevant? Is systematic risk. Their systematic risk is 16% of their risk. Right? And to allocate for it, of that 16%, how sensitive is the market? So that 16% is 10% more sensitive to the market than the others. All right. So how much of their risk is unsystematic risk? 84%. Okay. So 84% is their risk is unsystematic. So total risk is systematic risk for most stocks. That's not a very big number. 20, 25, 30%. And then the rest is unsystematic risk. Unsystematic risk, the word easily is important. Why is that important? Because you can go to Vanguard and buy the total US stock market and you have zero unsystematic risk. You're about as diversified as you can be. All of that unsystematic risk just disappears. So easily, very easy, you can do it in one transaction. The second word is very important as well. You notice I didn't use the word reduce. I used the word eliminate. It goes to zero. Right? That's pretty cool. You can completely eliminate your risk. By doing what? Real simple. You just add more stocks to your portfolio. And at some point, around 23, 24, 25 stocks, you probably don't have any more unsystematic risk. It starts disappearing. There's different studies, just depends. So systematic risk is what Sharp says is the only thing we care about for an individual stock, because that other 84% is just going to completely disappear once we put it into a portfolio. Of that 16% that is systematic, all right, now, Alec, how sensitive is Apple? They're 10% more sensitive than the average stock. So if we're trying to figure out a discount rate for Apple, we're going to give them a higher discount rate because they're more sensitive to the economy, to the market than the typical. What's the typical stocks beta? 1, right? 1 is the typical. So stocks that are very sensitive to the market are going to have a high beta, 1.5. Those that are not sensitive, 0.5. What would be a company with a really low beta? Can you think of one? Walmart? What about Duke Energy? Would they be low beta? When you have a recession, how many people cancel their electricity? Not very often, all right? You're going to buy food, you're going to buy electricity. What would be a high beta stock? All right, so discretionary retails. Are you more likely to cut back on Lululemon or buying a new car if you have a recession? New car might be a little higher. Yeah, when's the last time you heard someone say, you know, I'm worried about losing my job. I mean, I need to go out and buy a new car. Probably not that conversation, right? They're gonna probably cut that. What about Carnival Cruise? Man, I'm worried about losing my job. I think I'm gonna get a Carnival Cruise lined up here. Probably not gonna do that. So travel, leisure, those consumer discretionary, airlines, those type of things. Airlines are kind of a double hit because people cut back on vacations and companies cut back on travel, and business travel is huge for airlines. And so you get that double whammy. Y'all remember when we were talking about bucks under question 1? What were the 2 categories there? Not style, that's growth and value, but under bucks, beta, we had 2 types of companies. Cyclical and defensive. Which ones are the high beta? Cyclical and defensive, right? So it gets back to that first exam. So cyclical stocks are going to have high betas. Why? When the economy is doing badly, they're going to do really badly. If the economy is doing well, they're going to do really well.
You consider like defense companies to be secure or defensive.
A what?
Defense companies, like when the day like
Defense companies are generally thought of as defensive companies because governments tend to spend more during a recession. And so they tend to get more money. And they're also kind of unrelated. Governments rarely are going to cut their budgets during a recession. They may not increase defense spending, but they're probably not going to cut it either. Yeah, defense company. But that gives you a problem with like General Dynamics. Half of them is defense, half of them is airlines. So they're a low beta and a high beta company all in one. What would happen if they split into two companies? They probably wouldn't do that because they have a lot of synergies. So it's possible, it's hard to tell sometimes, but a Lockheed is probably going to be lower beta. We can see, we might test them to see what's the lowest beta will normally be. It's unlimited. You can have negative $1 trillion. Just borrow a lot of money and buy put options on the S&P, but what would the lowest you go? I never go below 0.4, personally. Now you'll see some, I've seen Walmart negative beta for like a 3-year period. Walmart was one of the only stocks up in 2008, so you can kind of argue that. The problem with a negative beta that we're going to see is that means if the 10-year treasury is making 4%, you're comfortable with Walmart making 3.5%, and you would invest in that stock. And I don't believe anybody believes it. Some people say gold stocks are kind of negative betas because gold tends to do well in bad times, but I don't believe that either. I don't think anyone's going to buy a stock expecting to make less than the treasury. It just doesn't make sense. So I never go negative. So 0.4 is my lowest, and 0.4 to me is going to be not Kroger's. Kroger's is a grocery store, but the problem with Kroger's, and we'll talk about this, Kroger's has a lot of debt. When you have a lot of debt, it tends to push your beta up. So if Kroger's didn't have much debt, then yeah, I might have Kroger's as a low beta. Now, what did Tim say about the beta for movies? Do you remember his comment on that? You go on a recession, what do people do with movies? Read or less on? Who else was there? Oh, Beverly, you're there. Remember what he said?
Yeah, they go to the movies during the recession.
Yeah, he kind of argued that it may actually be a lower beta than you think because people cancel their vacations and they say, hey, if we can't spend $1,000 on vacation, we need to spend $100 on movies. I don't know if I believe him on that. I got to go see the numbers and see, but it's possible. The more around, he makes the argument for Ferrari being a low beta stock. Why would Ferrari be a low beta stock? Who buys Ferraris? How many of y'all have a Ferrari in here? Not too many college students. So who buys Ferraris? Billionaires. Are billionaires worried about the economy? Oh my word, I need to cut back. You know, I spent 100 million last year. I better cut back to 80 million. I mean, they can't even spend their money. So buying a $500,000 car, it's like, you know, they're going to keep spending. They don't really care. So, so you have to think through it carefully to know, you know, to me, a Netflix, are people going to cancel the Netflix in a recession? Maybe the same argument with studios. It's like, we'll keep that, we'll cancel all our other. Who knows? It's in the numbers. We'll have to just look at it. So it's not always obvious. It's pretty obvious Ford is a high beta company. They sell the discretionary item and they have a lot of debt, probably almost more debt than any other company, S&P 500. That's going to give you a high beta plus a lot of fixed costs. All right. So William Sharp's saying ignores unsystematic risk. Completely ignore it because we can so easily eliminate it. It costs us almost nothing to do that. So we're focused on systematic risk. So systematic risk is not measured by betas. What beta measures is the relative amount of systematic risk we have. Because we're going to use the market as our risk premium, and then we're going to adjust it by beta. So if your stock has the same systematic risk as an average stock, then you're just going to use the market's risk premium. Whatever you do for buying stocks in general. If you have a beta of 1.1 like Meta, then you're going to add an extra 10% to that risk premium. So it's a relative amount of systematic risk. So we don't say Meta systematic risk is 1.1. We say they have 10% more systematic risk exposure than the average stock. All right. I know y'all have seen this, and you're probably going to see this in every finance class. You can just keep hitting y'all over the head with this. So we hope this theory is correct. Is it correct? So just try this. You can see some really good articles if you just type, is beta dead? Is beta dead? Is beta dead or alive? That one's not it. What is beta? But if you just do, I hate to do as beta dead because there's a new movie out that's for some reason that keeps coming up. Is beta dead again? Is beta dead? So yeah, that Walking Dead movie started coming up like last year. I don't know what that is. It has to do with anything with, I don't think it has anything to do with William Sharp. But there is some debate. Does beta actually work? So how do they test it? Well, it's pretty obvious. If stocks that are cyclical have high betas, then the market should demand a higher return, which means high beta stocks should historically have had higher returns than low beta stocks. And is that true? And it depends on whose research you look at. You get answers. I've seen research that says it's the exact opposite. Low beta stocks actually have higher returns than high beta stocks. That destroys the entire theory. I've seen some theories that say the opposite. So it's a big debate. It's a lot of uncertainty on exactly how to look at that. But we're going to go with it. You're going to see when we do paper 3, I actually like the theory of beta if you calculate your beta correctly. All right. So if you have a beta of 1.2 and you expect a recession, you want to lower that beta, just like you're going to talk about under bucks. And it's really easy to do. You just sell your high beta stocks and buy your low beta stocks. Really, really, really simple. The beta of your portfolio is just the weighted average betas of all your individual stocks. So it's a really simple. There's no like adjustment you got to make. It's really, really simple. You sell your high beta stocks, buy your low beta stocks. And your unsystematic risk disappears. So you can't expect to be paid. So if your entire portfolio is in Meta, and so you do your analysis, I got to come up with a discount rate, and you look and say, man, I got 11% standard deviation on a monthly basis, 30% annualized. Wow, I need like a 43% return on Meta. And so you do your calculation, look at your cash flows, you value it, you come up with a price for Meta of $3.17. So you call your broker and say, I want to buy Meta for $3.17. And your broker says, well, it's trading for $340 right now. And says, well, what if it hits $3.50? I want to buy it. It's like, why would you think? Said, well, here's my discount rate. Said, yeah, your discount rate's awfully high. And you said, yeah, but I can't use CAPM because Meta is the only stock in my portfolio. Well, can you demand the market to compensate you for taking undiversified risk? No, that's your fault. That's your problem. They're not going to compensate you for that. The other thing that's interesting here is take the Butt family. So the Butt family, let's say all their wealth is in HEB. So do they have a well-diversified portfolio? Does beta make sense for HEB? What kind of beta would HEB have if it was a publicly traded stock? Really, really low. Their discount rate really, really low. So if you value the HEB, maybe, I have no idea, maybe you get a value of HEB of say $20 billion. But the Butt family can't do that. They got to use a much higher discount rate because they're not diversified. So they may get a valuation not of 20 billion, of say 2 billion. What happens to the HEB family's wealth if they go public? Their wealth goes from 2 billion to what? 20 billion overnight. Do you think there's an incentive once you have a bunch more butts out there? You know, if you only have one butt, and I think he passed away, right? Once you get down to grandkids, you say, you mean my wealth can go up tenfold and all we got to do is IPO this thing? They're going to eventually do that. Why? Because they're going to diversify their risk out. They're going to get a much lower discount rate. If you want to, you look at Zuckerberg and saying, I don't really want to go public. I hate markets. They're, it's just constant. His wealth is going to zoom up by simply going public because your beta drops dramatically. Why? Because suddenly you don't care about your total risk. You only care about your systematic risk. So your discount rate comes down a lot. All right. There's the definition of beta. The numerator is your covariance. And then the standard deviation of market squared. You can use the covariance divided by the standard deviation of market squared, or you can use the slope. On paper 3, you'll use the slope formula more than likely because it's a lot simpler to do. And we'll see how we do that. All right, let me show you this mathematically with actual real life numbers. We've got what, 15 minutes? We can do this. Okay, so what I did is I brought in 9 stocks. Now, it is important when you diversify your portfolio, you can't diversify your portfolio by buying 20 tech stocks. So you do have to be in different industries, right? But these are 9 stocks and a bunch of different industries. So Apple, so give me the industries. Tech. Consumer discretionary, right? Ford. Ford's a little tricky because Ford owns something called Ford Motor Credit, which is essentially a big bank. This looks a lot different than Ford. So the numbers can get a little tricky. What about this next one? That's a bank, right? Them. Huh? 3M? Yeah, I would think of them as kind of an industrial, but they may have real estate. I don't know. 3M, you know, industrial seems a little extreme because they do like Post-it notes, but they do some bigger things. What about this one? Yeah, but it's defense industry, right?
Yeah.
So it could be, you know, who knows? What about them? I made a mistake in investing in their stock. So AT&T, watched it go flat for years. It's like, could they just go up 1% every once in a while? Just flat. They paid nice dividend, but boy, the stock never moved. What about them? Are they retail or are they healthcare? Both, right? How much of their business is retail versus healthcare? Pharma's probably a big part of it, but they're not really a pharma, are they? How many drugs does CVS produce? You know, they're not, you don't think of them as a pharma, so they're almost more retail than they are healthcare, but so there's consumer staples. Remember, there's 2 consumers, there's staples and discretionary. Ford is discretionary. What about them? Energy, right? What is energy? Energy is interesting because gas is definitely going to be hurt by recession because people will be driving to work. But at the same time, people tend to buy gas, not as much as utilities. They may cut back some, but they will tend to, if gas prices are high and food prices are high, they tend to cut back on everything else and keep driving their cars. But it's hard to say. Energy is kind of a close to 1 kind of thing. What about a McDonald's? I don't have McDonald's in there. Is that high beta or low beta? Yeah, it's kind of a 1 beta, but kind of a low beta. Why? Because there's no cheaper place to buy calories almost anywhere, right? And not good calories, but if you need calories, you can get them pretty cheap. Oh, they're getting kind of expensive to me. There used to the store next to where I worked. The store was called 39-cent hamburgers, which I always thought was a stupid name for a store because it's like you never raise your prices or you keep shrinking. But I don't know, what is a Big Mac today? $4, $5, $6, and it's crazy, right? No way it's worth that. But people still buy it. It's a pretty popular product. All right. So these are their prices. They're adjusted prices. Remember, we're using adjusted prices. So they look really, really small. That's because Apple's done a lot of stock splits. Walmart's paid a lot of dividends. So the prices these aren't their actual prices. These are adjusted for stock splits. And so what I do here is I get their weekly returns all the way through last week, weekly returns. And here's their average return. Apple has the highest return by far, really outstripping all the others. And it's also the biggest stock out there. So that kind of makes sense. You can see most of the returns are, 10 to 15% kind of returns, and Apple's way up there. Here's their standard deviation, annualized standard deviation. So I do STDEVP for that series, and then I raise it to the square root. Well, it's weekly here. So here I don't do the square root of 12, I do the square root of 52, which is 52 weeks in a year. So there's standard deviation. So if all of them had an R squared of 100, then if I put Apple and Ford in my portfolio, my return would drop to the average of those 2, which would be 21%. But if their R squared is 1, my standard deviation would be about 41%. But the R squared is not 1, my standard deviation can be much lower. Why is that? Well, let's look at it. Look at the first week. Apple's down 3%, Ford's up 1.8. Ford just reduced a lot of your risk. Down here, Apple's up almost 5%, Ford's down 0.68. Look at that one. Apple's down 15%, but Ford's up 6%. Is the R squared 1? Not even close, right? It's pretty far off. If we do Apple, two very different companies, right? So the R squared is like 6%. Very unrelated. They're almost completely unrelated firms, which means a lot of the risk is going to disappear. So over here, what I do, so say, what if we combine Apple and Ford 50-50%? And the standard deviation of that portfolio is not 41%, it's only 32%. We reduced our risk a significant amount by just putting those two stocks together. Now, return came down. Now, if you knew for sure that what Apple was going to do, what would you have done? I'd put all my money in Apple. But we don't know that, right? And so we're trying to reduce our risk here. So by combining those two stocks, our risk dropped all the way down to 32%. If I take Apple, Ford, and Bank of America, their average standard deviation is about 41% again. And that's what our standard deviation of portfolio would be if they had an R squared of 1, but they don't. They're unrelated. And so when we combine those three companies, our standard deviation drops all the way down to 30%. We're already a fourth lower just by adding three stocks together. We do 4 stocks, it keeps dropping, keeps dropping. Those 9 stocks, the standard deviation is only 18%. The average risk of those 9 stocks is 30%, but our portfolio's risk is only 18%. We cut our risk about 40% just with 9 stocks. And if we keep doing that, what happens to our unsystematic risk? It keeps falling and falling and falling until it goes to 0. The market risk is 16%. Our risk of these 9 stocks is 18. We're not that far from the market. We're just 9 stocks. Now I'll pick them from several different industries. So you can see how diversification has a huge, huge impact on the risk of your portfolio. It's pretty dramatic. Risk drops really fast just by diversifying in a few other names. What about bonds? Think back to CAPM. What does CAPM stand for? Capital asset. Are bonds capital assets? Yeah. Is real estate a capital asset? Yeah. Is infrastructure a capital asset? Yeah. Do we use CAPM for bonds? What's the next word? Cap pricing. Does CAPM price anything? No, it just gives you a beta to put into a discount rate to price something. So that's pricing. Right. What's the M stand for? Model. Is CAPM a model? No, it's just a formula. So William Sharp is really good except for naming stuff. So it's not capital assets. We only apply beta to stocks. Right? I've never seen beta apply to real estate or to bonds. It's not a pricing model, it's a discount rate adjusting model, and it's not a model, it's a formula. But I don't know what acronym you get if you do all that. But the problem with bonds, so if you think about with stocks, we're talking about unsystematic risk. So I mentioned if Meta is up 12%, Google might be down 12%, so they offset each other. With bonds, you don't get that, right? If you're invested in Enron and it falls 80%, do you have a bond in your portfolio that's up 80%? You don't, right? There's not that upside. So the problem with bonds, CAPM assumes this nice rate, that unsystematic risk, bad news is offset with good news. With the bonds, good news is not going to shoot you up 10, 20, 30%. You might be up 1% because it gets upgraded. But if a bond's in trouble, you're going to be down 80, 90%. And the best you're going to be up is only a little bit. CAPM doesn't work for bonds. They're not normally distributed. There's a lot of downside and you're really limited on the upside. So that's where we use duration and convexity to measure that type of risk. And there's something out there called, you should look this up. This was created after I retired, so I had to call my friend at work. It's called spread duration. And maybe there's spread convexity as well, but you can look at spread duration. I don't see the point of it, but the guy from Victory Capital, they say they use it. Spread duration is telling you how sensitive your bond is to changes in spread. So duration tells you how sensitive you are to changes in interest rates. This talks about how sensitive you are to changes in spread. But since spread is just part of the interest rate, I'm not quite sure what extra it gives you. But there it is, spread duration. And it's become a term. I don't know when it was invented. If it was invented before I retired, no one was talking about it. I'm sure there was some article written by some professor out there. So for bonds, we're worried about duration, convexity, and then credit risk. So that's our main focus. CAPM is not going to help you with that. Beta is not going to help you with that at all. It's just not the right term. And yeah, standard deviation is not going to help you. It's just not the right number. Okay, so to get into this CAPM, so you had it before. You had 3013 not with me, then you're gonna wonder what I'm talking about because I do it very differently. If you had it with me, then you're not gonna know how weird I am. So JJ and Beverly, and then you'll just have to figure it out in your next finance class how skewed, how corrupted I made you. But beta is a statistical number you can calculate. We just did it for meta, that 1.1. But that is what we call a regression beta. It's just a historical beta. I don't like historical beta. You're going to use on paper 3, you're going to use a historical beta, but you're also going to do 3 other things. Anybody, Emmanuel, JJ, Beverly, y'all remember the 4 steps? They're not up there, are there? Step 1's up there. Y'all remember the 4? Y'all did it.
Yeah.
You had to write an exam question on the last part. So I've come up with 4 steps. The reason I do it like this, several years ago, one of my portfolio managers was in town. I wonder if he's still alive. He's an old gentleman. Really had a lot of respect for him. Really brilliant guy. He ran a quantitative equity fund. But he said, "Hey, I'll come talk to your class, security analysis class." I said, "Yeah, that'd be cool." And he says, "Oh, but just be aware, I might contradict what you tell the class." And he hates beta. So he came in and he showed beta, and I started copying what he did in that class. And I'll show you what he did. It's that rolling beta kind of idea. So he wanted to prove to me beta was a bad way to adjust risk. I disagree with him. I like beta, but taking what I learned from him, I came up with this 4-step process. I was really worried about it because I was like, okay, I'm this professor without a PhD teaching my students something. And then I saw the Mortaran does the exact same thing. So whether he got it from me, I seriously doubt it. He has no clue I am, but I didn't steal it from him, but somehow a really smart person, and I came up with the same thing. So I'm going to show you that. So I feel much more comfortable that that guru has the exact same process. So let me show you the process real quickly. Step 1, figure out if your firm is defensive or cyclical. Okay, that's what I call relative sensitivity. Then the next thing you got to figure out is how do revenues get the net income? And there's 2 leverages you got to worry about. See where they are. Where is it in those? So the 2 leverages you have to worry about, the first one is operating leverage. Firms with a lot of fixed costs are going to be a lot more risky than firms with low fixed costs, because their revenues could be much more. If you have a lot of fixed costs, bad year, you got to keep paying those costs. All right. And then the second leverage is financial leverage. I just mentioned that with Kroger's and Ford. A lot of debt, that's going to shoot your beta up. All right. And then the last one is what? Well, the last one is that regression beta, that history. All right. You can get data from Yahoo Finance, but what are you getting from Yahoo Finance? They even tell you. We can look at Walmart real quick. So Walmart, they say it's 0.54. That seems reasonable, but this number has been negative at times. I remember one time Ford's beta was 0.65. Would you use 0.65 for Ford? It'd be really low, right? But what is the beta they're showing you? The regression of the last 5 years on a monthly basis, the last 60 months. That used to be 3 years weekly, and they changed it to 5 year monthly. So you might see some of my YouTube videos where I do 3 years weekly, because for some reason they switched. I don't know why they switched. You actually can get pretty radically different numbers if you use weekly or monthly. So that's just one beta for the last 5 years. The last 5 years, anything unusual happened in the last 5 years that might, remember those outliers are so sensitive. So we might not want to do that. So I'll show you how I'm going to do it. So beta is not a number you get off of Yahoo Finance. What I'm going to show you with this number is you can use this number to make sure you did the rolling beta correctly, because your very last rolling beta will be this number. And if your last number is 70.79, you probably did something wrong, because it should have been 0.54. All right. So we'll be doing that next Tuesday. The if you're really, really worried about the exam, set up a Zoom or call or something. Don't send me your answer and have me check it. I'm not gonna do that. I can't do 50 emails, but if you want to talk about it, you can.